Sorry, guys. Welcome, everybody, to our monthly lunch and learn. Thank you for coming. We have a very special group of people here today that have taken a lot of their time and traveled very far to get here just to make this presentation happen. So we're very grateful. First, I want to thank our premier partners, Stearns Lending, which is Laura Zachrin and Carrie McMurray. They provided the lunch for you guys, so let's give them a round of applause.
That's right, feed us.
And I want to introduce someone who's traveled all the way from Sacramento to come give you the special presentation from CalHFA, Molly Ellis. And we want to give her a round of applause for coming. Thank you. I want to remind everybody to ask clear questions. Raise your hands. Molly, if you don't mind repeating the question if it's unclear, we do have a webinar going at the same time, so there's people, another audience that's not here. Right. All right, so yeah. I'm going to let her take over, and once again, thank you.
Thank you. Thanks, Omar, for having me. I appreciate you all so much to take the time. Thank you again to Stearns for feeding these wonderful people so they are willing to come and sit and listen to me for a minute today. That always helps. Food motivates, right? Thank you all so much for coming out this afternoon. We're going to learn a little bit about some affordable financing options that are available. I have some down payment assistance, closing cost assistance programs that I get to talk to you today for a first-time home buyer, and even some more affordables like lower MI option in certain areas, even a lower rate option for even your non-first-time home buyers. So lots of cool stuff that I get to talk to you about today. Stearns is definitely one of CalHFA's direct lenders. Omar's group has access through Stearns and to be able to do the CalHFA product, and he's been through the full-blown training, but just wanted to take a little time today to give you just this little nugget of information so that you know that these programs are out there and how they can assist you to help your clients, help you, help your clients, help you. Yes, it all works, right? All of the above, but it can help grow your business, and it can help you put more people into houses and maybe even help you as well on the listing side. So I hope to give you lots of good information today. I did pass out and yell, please, if I missed anybody, if you would pass those up that side, please, maybe even more. Our little brochure, this has the entire CalHFA product line in it, little flyers on all of our programs. It's got a little place to take notes on the back, doodle if I get boring, but I'll really try hard not to get too boring on this stuff. And then a little reminder to sign up for our e-news if you would like to get quicker information about the CalHFA programs and the changes we've made. First thing straight out the gate, what I'm going to ask you to do is, if you haven't looked at a CalHFA program in the past maybe year or so, I just want you to keep an open mind and maybe look to the program with a little bit different eyes. If you don't know what I'm talking about, I'm not talking about anything. If you do know what I'm talking about that it hasn't always been a simple program to do, and we have made major changes over the last, I would say we've been consistently making changes over the last maybe 2 or 3 years, but even as soon as just March, we made a significant change. So in January and March, we made 2 significant changes. So we are constantly trying to make the program a little bit easier to be able to fit in a little bit better with your normal processes. So hang out with me, check out the programs that are available. It's not going to be the be all that ends all, but it's definitely going to help you put more people into houses. And whether you're here with Omar's group, whether you're here with Stearns, myself, your real estate businesses, we are all have one similar goal, right? And that is to put people in houses, right? Yes. So it works for all of us. So lots of good contact information on this front page here. Our main number in Sacramento for the agency is the 916-326-8000 number. Our single family lending, so this is actually a little shortcut to the people who actually do work on your loans, that 8033 number, and then the email version of that. So if you prefer email instead of picking up the phone and calling, you can definitely email us at lendertraining@calhfa.ca.gov as well. We are your training and outreach team. That is where that phone number rings to, not the 8000 one, but the single family one. And we can help you with scenarios. We can translate guidelines for you. We can check status for you. Any help that you need with regards to that loan that's in process, we can help you out with that. But at your fingertips, you also have a lot of information available to you as well. And it's the website, 3ws.calhfa.ca.gov. It has what day we're working on posted every single morning. So you know turn times on the CalHFA product at all times. You know interest rate. There's program handbooks for every single program and then some that we are going to talk about today. So that also has just a wealth of information. Please take a minute to check out the website. I'll go over some other little tips towards the end. I've got videos on there. There's all kinds of cool stuff going on the website. So take a minute and check that out as well. Okay, Jonathan told me not to push one button, so I'm not going to push it. But the one I thought I was supposed to push.
It's supposed to work. Hey, guys.
Hi, Jonathan. That's the right one, right?
Yeah.
Clicker works a lot better on this side.
Good watch.
Oh, I thought he said it was the
Oh,
opposite.
that's right, okay.
Yeah. So here, hold on. So are you doing anything or no?
Oh.
All right.
Did I do that?
Here, hold on just a second. Sorry, guys.
I can use the mouse. Okay.
Oh, no, it's okay. Let me see. Oh, yeah, you should be okay.
Awesome.
You good?
Cool,
All right,
thanks.
cool. Awesome.
All right, sorry for those folks tuning in on the webinar. Just a tiny bit of technical difficulty for a minute, but we got it. All right, so a little bit about CalHFA. Well, first, sorry, a little bit about me. I'm going to go first. So my name's Molly Ellis. I've been a trainer with the agency for almost 20 years. I've been with the agency for almost 21 years, but I actually came from lending. So I speak a little weird state program, but I speak a little lending as well. So that's really kind of my approach to these classes is I am not going to tell y'all how to write a contract. I know you know how to write a contract, but understanding that these programs are available and how you can use them in your everyday life to build your business, and knowing that you have the Stearns partnership and Omar's group for the partnership. It's Simple Mortgage, right? Okay, sorry, Simple Mortgage, that partnership. That's half the battle right there, because you have all the players that you need to get these loans done in this room right here, right now. So that's really kind of the approach, but there's a little bit to be said about the agency as well. The agency's been around since 1975, so lots of ups and downs in the market, lots of different ways that we've been trying to meet these goals over the years, but right now it really is with the down payment and the closing cost assistance. Number one reason a Californian can't buy a house right now is not because they can't afford that monthly mortgage payment. It's because they don't have that chunk of money. Even if we're talking a modest 400,000, I almost said square foot. Could you imagine? 400,000 sales price property. Even at that modest level, we'd be talking what, 25, 30 grand, even with minimum down payment, minimum closing costs. So many of us just don't have that kind of money readily available, liquid sitting in our savings account. And some of us don't have, someone that we can get a gift from. So this actually will bridge that gap and help with that. We get to lend because we are a state agency and we are a housing finance agency. We have special agreement with Fannie. It's a little bit cheaper to do. We don't have loan level price adjustments. We have a cheaper MI. There's all kinds of cool stuff going on behind the scenes. And we can do this layered financing. We can do a second and sometimes a third lien to lend the borrower their minimum down payment in most cases, and to lend them 2 or 3% in closing cost assistance. So when you do all the math and that comes out, that's leaving maybe just an earnest money deposit, or you throw a little seller concession in there or something like that. Anybody can help out in this transaction. That could be what makes the deal work, right? And then instead of paying a first and last month's rent, let's create some home ownership. And that's where this program is going to fit into your everyday. All these programs are administered at no cost to California taxpayers. We are self-funded. We are not part of the state budget. So when there are budget concerns, we don't have to worry about it. It's kind of a cool thing. And I always like throwing that out there. But we do have rules, right? So our state statute says that we are providing a service to a low to moderate income first-time home buyer. But don't let the low to moderate income dissuade you at all, because our low to moderate income now, and this was one of the things that happened that changed in January of last year that was so major, it's a true California low to moderate income borrower. And that is very different. So for so long, programs like ours were limited by averages for the nation. California, it's just more expensive here. We make more money here because we have to pay more money to live here. And so this is a true California low to moderate borrower. So it's going to work in a lot of cases. And if you'll allow me, I'm going to save that little nugget in my hip pocket for a little bit later. I'm not going to give my punchline out yet and tell you what the income limit is. So this program works because of the Simple's relationship with Stearns and Stearns' relationship with us. So we already kind of talked about that. But I want to be super clear here. Stearns gets to underwrite your loan. Simple gets to originate it, process it. Stearns gets to underwrite it, just like how it happens on every single one of your other deals, okay, with this relationship. It works exactly the same way. We do not underwrite files, and that is a huge misconception out there in the world, is that it's going to have to go through a whole second underwriting side, and we do not credit and property underwrite these loans. We realize that's why we only contract with our direct lenders like Stearns, because we need their expertise to be able to provide that underwriting function for us. So what Stearns is going to be looking for is regular guidelines. This is another thing I love to get out there straight away. It's FHA guidelines on an FHA loan. It's Fannie Home Ready guidelines on a conventional. It's VA on a VA. There's nothing, I don't have my words on this. There's nothing weird going on. I know that's weird that I said it that way, but it's not. 95% of the guidelines are exactly what they would be whether you were going CalHFA or not, right? On a conventional FHA or VA loan. On your conventional stuff, though, it is a Fannie product, not a Freddie. So just keep that. So if there's anything that you rely on your lender, certain scenarios that you rely on the Freddie Mac product, I can't do that. Our relationship is with Fannie. They're the ones that gives us the loan level price, there's no loan level price adjustments, the cheaper financing, all that good stuff. So it is a Fannie Home Ready product. We have an exclusive agreement with Genworth. So on your conventional over 80s, the mortgage insurance will be coming with Genworth, but Stearns has that relationship. They're even delegated, so they get to do the underwriting for Genworth all in the same package. Now, what CalHFA is going to be looking at, because we are going to look at this file, but it's depending on the program or the programs that's going to be submitted to us, it's anywhere from 10 to 13 items that Stearns is going to upload for CalHFA to look at. I'm not recredit underwriting that file. I'm looking at the program side of the file. Are they a first-time home buyer if they need to be? Are they within our income limits and our sales price limits? Did they complete their home buyer education? Did they do their form? In many cases, it's literally one form, two at the most, form or forms correctly. That's all CalHFA is looking at on that review. So it's a quick, easy review when it comes to the CalHFA side. I'm also not going to stand up here, I don't want to lose any credibility. I know it's tough on you guys because that process does happen at before docs. So when you're down to having a file ready to go to docs, everybody's antsy, right? We're ready to go. We need docs. We want to get this deal closed, this loan closed. We understand that, and that's why we're constantly trying to streamline this process. So it is a submission to CalHFA, but it's an upload. We haven't been over 24 hours in our turn time since before the beginning of the new year, since before the holidays. So it is really a quick, easy process for that upload. Yeah.
Just really quickly.
Sure.
These loans, make sure you set yourself up to win, will not work on a 21-day escrow. Make sure that if you're gonna do PPA, you give yourself at least 30 days. Okay.
So I'm going to talk about the product line. The CalPlus Conventional is one of the most popular CalHFA programs that we do. It is a conventional version, so this is going to follow, again, about 95, maybe even more, percent of the guidelines are going to be Fannie Home Ready guidelines. So on a regular Fannie Home Ready, you can go up to 97 LTV on that first mortgage. So your borrower's minimum down payment is 3%. But I'm going to show you when we talk about the down payment assistance, a 3.5 or a 4% down payment assistance program that can go together with this to actually take care of their minimum down payment. It's a loan, but it will actually take care of that minimum down payment. Huge misconception on the CalHFA product line is that it's only going to work on the $300,000 condo. It's not true. I can go over conforming even. I can go over 48350 because we're in LA County, right? And because Home Ready and FHA allow, specifically Home Ready on the conventional, allow a higher loan amount limit in LA County because it's more expensive to live here, right? That we can exceed that 48350 as well, but there is a fee. So there's a point there where your loan officer is going to start kind of weighing this out to see whether it's really worth it to go CalHFA, because if you're charging to do the CalHFA product, then it starts to outweigh the assistance, right? So there is a little bit of a balancing act there. And then while I'm talking about that, I'm a little off topic here, but I want to make sure that we get this in. Please keep in mind that these are borrower, what on the lending side we call a borrower paid transaction. But if you do a first, second, and a third, I'm going to show you assistance that can cover the bulk of their closing costs. And their minimum down payment in most cases. But if you have a little money from the borrower, a little money from a seller concession, a little money from the agent to make the deal work, those can work on these loans. And it can be a huge benefit. And I'll just tell you, I learned something new, and I can't have favorites, but we were talking through some of the program stuff with the Stearns group today, just now, and I learned something new. They're charging minimal on this. When you go to a lender that charges more because you're doing CalHFA, your client loses the benefit of the program. Not all the way, but a little. It does lessen the benefit of the program. When you have somebody that's only charging 1.5, something like that, it actually, then the help can go towards the client a little bit more. So just my little public service announcement.
Actually, Simple Mortgage is charging.
Yeah,
the minimum.
sorry, Simple, yeah.
Yeah.
Right.
And
The
so
minimum.
what she means, just let's be very clear, what she means is as agents, there is nothing preventing you from kicking into the transaction part of your commission to make it work. I had an agent back when we were doing these the hard way that made a killing because what he was doing was he was earning 2.5% and offering half a point all the time on all deals for down payment assistance programs. Okay, so yeah, he was making 2%, but the referrals just kept coming because he kept kicking people back money to make their down payment assistance loan actually work. Okay, so know that if the borrower is very short on cash, your commission can come into play here, and there are no overlays to that. We will be able to do that.
And you'll
Also,
see
seller concession. So if you get seller concession, you can use all of it towards these programs.
The closing costs. So the big thing here too is the CalHFA product line alone will, in most cases, and some it will, but in most cases, it will not allow your borrower to move in with absolutely no money into the transaction. But with a little help, it actually could. So that's the other thing. So it's not a 000, right, type loan, but it can definitely go a long way to help. All right. So back to our CalPlus Conventional. It's a home ready guideline, and I've said that a couple of times now. So I have a little test for you. Does anybody know what one of the big concerns with doing a home ready program, especially in LA County, is? Can anybody think of it? Like, was there anyone that went, ugh, when I said home ready?
Max income limit?
Yes. I did not pay him. I did not pay him an answer. He nailed it. Yes. So one of the biggest concerns with a home ready is the income limit. But guess what? When you use CalHFA's conventional, even though it follows home ready guidelines for the most part, it's actually the HFA preferred. HFA stands for Housing Finance Agency. California Housing Finance Agency is your housing finance agency for California. So we have a special deal with them that in the guideline, it actually says to follow the HFA's income limits. So now I do have to tell you my punchline because I can't walk away from it now. It's on the presentation, so you don't have to write this down, but I just want to give you an idea of what I'm talking about. The home ready income limit for LA County is 88 and some change, right? Am I in the ballpark?
Some places it's only 64.3.
Oh, or okay, sorry, or 64.3. CalHFA's income limit in LA County is 128,000. That's a real low to moderate income California home buyer. That's going to help a lot of your people, and that could be one borrower, or it could be two, or it could be four. It's whoever's on the loan. It doesn't matter household size anymore. None of that goes into it anymore. We use what your lender uses, and the income that is required for you to get them qualified. That's what we use for that 128 number. So it's just a great way to be able to utilize the CalHFA program. Plus, we're going to throw on top of that a sale. It's Macy's Wednesday sale. On the mortgage insurance. The mortgage insurance is cheaper when you're doing a CalHFA loan than it is on a standard. It's significantly cheaper when you're talking about a standard conventional. And even if we're talking about a regular home ready, it's a little bit cheaper. The coverage is cheaper, so their monthly amount is cheaper. If that is less money that's going into their monthly payment, what's that mean for you? They can qualify for more house, right? It translates to a better debt ratio. It translates to another house that was just outside of their budget. Now you can go show them, right? It translates to more options for you and more options for your borrower. All right, that's the other big benefit. So it's also going to come with the ZIP program, and the ZIP is, we at CalHFA love us a good acronym. So we call the ZIP loan the zero interest program. We call it ZIP. It's 2 or 3% of the first mortgage. So that's a little weird. It's not off of the sales price. It's of the first mortgage loan amount. At a zero interest rate, deferred for the life of the loan. Simple, does not have to calculate that payment into a debt ratio. It's not going to negatively affect the way the borrower qualifies for the mortgage. It's only going to help their cash into the transaction. Okay, so there's no scheduled payments. They don't have to make a payment. They could if they wanted, but they don't have to. All right, it's a loan though. It's not a gift. It's not a grant. It's a loan. It's a note that with a deed of trust that's going to be secured against the property. They will need to pay it off at the first of a refinance, a sale, or at the end of the term of the 30 years. So it will never defer, or it will never, that's not the word I was looking for, forgive, right? It will never forgive. It will need to be paid off eventually. But it's at a zero interest rate. It's such an affordable way to get their down payment financed. If they say they move in 2019, they use CalHFA and they use a ZIP loan at a zero interest rate. They borrow $10,000 on their ZIP loan to help with their closing costs. If they pay it off, they refinance or they sell and move on, whatever it is that they do, in 5 years, they're still paying back $10,000. But say they stay put and now we're in year 20. They don't refinance. They had a good loan. They don't refinance. They don't sell it. So we're in year 20. It's still $10,000. They're only going to pay back their principal amount. They're not paying back any accrued interest on this one. So it's kind of cool. All right.
And it just stays as a lien?
Yep. It's an actual deed of trust.
Okay.
So right now, I know it looks like it's in second lien position, but I'm going to show you an option for the down payment piece. That's going to actually sneak in second and push zip to third. So you can do it for second, or you can do it for second and third. The other cool thing about these programs, it can really be customized to work with just about any potential homeowner. You can, it's less expensive to use less of the financing, right? So if they don't need it all, then let's not do it all. Let's get them a cheaper loan with less down payment and closing cost assistance. So it can really kind of be carve out what really works best for your client. All right. So I'm going to show you how to combine it with either the school program or My Home. When we are looking at the 2 or the 3% zip, we are talking only closing costs though. Okay, so none of this can go towards their down payment. It can only go towards their closing costs. I want you to think of this a couple different ways, and this is just a tiny bit off topic, but I want you to apply this to your everyday life as well. So I'm going to show you how to, really have the borrower borrow. Sorry, that's weird. The borrower's going to borrow their minimum down payment, 2 to 3% in closing cost assistance. So if your borrower, if you're in a market, and I'm not even going to try to pretend I understand all your little micro markets, right? That you guys get to do that. But if you are in a market where all of the offers are coming in asking for closing cost assistance, do you think you can make this work for you? It was rhetorical. Yes, you can make this work for you, because then you have the ZIP program in your hip pocket, right? With your partners in this room. So you can write that offer with no closing costs. You can, with no seller concession. What's that going to do to your offer in that stack? It's going to go up, right? You're not asking for closing costs. So just another way that you can make it work. If your borrower needs closing costs and you can get, and seller concession is common and you don't have multiple offers, then yes, by all means. I'm not telling you to not do it, because there's definitely a benefit to having the seller concession, but I'm just showing you an additional way to utilize the program. Just something that might be able to help in certain climates. So we have a little closing cost assistance. What if we do have a little seller concession? What if the borrower has a little of their own money? It could happen, right? It could happen. So when you start to put all of this together, there's some pretty cool things that you can do with the CalHFA program. Now, again, my programs by themselves are not going to get you here, okay? But there are several, and I'm sorry, I went away from that. When we're talking mortgage insurance, yes, there's the cutter monthly mortgage insurance. But what your origination team at Simple is going to look at is, can we buy out the MI altogether? Especially if we have a little money, right? Yes, if monthly will work for your borrower, then great. Of course, we can do that, right? Monthly. Buy it out all the way. But Genworth also has 6 different split premium options. And this is another way that you can really customize this program to meet the needs of your client. Do they have a little bit of money? They can do a little upfront and then it makes their monthly go down. Maybe that's what helps their debt ratio. Or the higher, and there's 6 options. It starts at a half upfront, but every time you go up in the upfront amount, it lowers their monthly amount, right? All the way to buying it out all the way. So half upfront, lower MI monthly. 3/4 up front, even lower. 1 up front, even lower, so on, so on, so on. And there's 6 different options to do that. So again, just kind of throwing it out there. It's not the norm. Yes, monthly is the norm. We do that all day long, but it's just another way to be able to utilize the CalHFA program into the best fit for your borrower. All right. Now, we also have a Cal Plus FHA. So it's that. The conventional version is Fannie Home Ready, right? So of course now we have the FHA version. The difference between these two basically is going to be underwriting guidelines. So we all know that a conventional is a little bit harder, a little bit more strict qualifying requirements, right? It's no different when it's a CalHFA loan. It's exactly the same. So of course we need an FHA version of this program so we can help people who have, had a bankruptcy, that have had a short seller, a foreclosure, that have some challenged credit. You'll lean towards, or your lender will lean towards an FHA on that, right? So we can go Cal Plus FHA, And the cool thing about the FHA program is it'll finance 96.5%. I can still go high balance, but I'm not capped at 95 like we were on the conventional. If we go high balance on the conventional, we're capped at 95 LTV, not the 97. On the FHA, we can still go to 96.5%, making their minimum down payment 3.5, right? And I'm going to show you a down payment assistance program that lends them their 3.5. You could actually do 100% financing for a $600,000 house in LA County using this program. All right, and a little help with some closing cost assistance as well. But there is a fee. So when you go into high balance land, they're probably going to come in with some money, just so that you know. On what's the word? Sorry, the closing cost side. They're going to come in. They may have to come in with a little bit, but that's where your little 0.5% would go a long way. All right. So zip on this is still going to have that 2 or that 3% option, but we get a little bit more bang for their buck. I'm going to do a tiny bit of mortgage 101 for you, so please indulge me because I want you to see how much more this is of the total loan amount. So because we have an upfront mortgage insurance premium on an FHA, has nothing to do with us, right? That is a regular FHA loan. Say it's a $400,000 sales price, your mortgage insurance premium or that borrower's mortgage insurance premium is about $6,700. It's a chunk of change. So it's going to be your loan amount, the 96.5 plus $6,700 or so. That gives you the total loan amount. That's what your lender calls the total loan amount. That's what we get to base. It's just a little bit more money. So we take the 2 or the 3% from that larger number, right? To be able to lend that borrower at the 0 interest rate. We're still at a 0 interest rate, all deferred payments. Yes, it's a loan. It's not a gift. It's not a grant. It will not forgive. They do have to pay it back, but the interest is accruing at 0. Literally on the note that they're going to sign, the interest rate is 0 from right out the gate. Okay, so it's not forgiven over time, none of that. It is a 0 interest rate. I also have a limited 203K. Stearns, where's my Stearns people? Can I do a 203K? I'm sorry, I forgot to ask.
203K.
Can we do the limited 203K? Do you know?
Not at this time.
Okay.
Not for CalHFA.
Okay. It's not huge, but I was just going to show you where it worked if we did.
Yeah, we currently don't have programming for it, but
Okay.
it is going
In
to
the
be
works?
available,
Okay.
I would say, by June or July.
Yeah. So limited 203K, just kind of keep that in the back of your mind. If you've got that one listing that's like got the ugly carpet and the seller's just like, I'm not replacing it, it's not showing well, whatever. If you have an affordable way to finance that upgrade, that's going to bring more people to the table, right? And that's going to be one of those options when Stearns is able to do that. It's just $35,000, so it's not a ton. It's not a complete remodel, nothing structural, but it's a little $35,000 just to kind of put some pretties on it and get that loan or get that house sold. Okay. We also have, did I see a hand? Sorry, no. We also have what we call a CalHFA Conventional and a CalHFA FHA option as well. All this means is it doesn't have the ZIP program tied to it, okay? So when we add ZIP, the interest rate on the first mortgage is going to go up a tick. So that's when I'm talking about we can do something a little bit more affordable for the borrower if they don't need all the help that's available, right? So these interest rates are significantly lower on the first mortgage when they don't need that ZIP loan, okay? And once we add in My Home in the School program, it doesn't trigger a higher interest rate. They still get that lower rate with a little bit of help. Okay, does that make sense? Whereas with ZIP, we can put it with My Home or the School and get all the help, but it's going to be a little bit higher interest rate on the first. All right. So it's a lower interest rate. It's still FHA or Fannie Home Ready guidelines, but this is one of the things that we just launched in March. So we mentioned the Home Ready income limits, and in some areas, you'll be able to be in a no income area for Home Ready. If your borrower does fall in the Home Ready income limit, they get a whole 0.5 point less on their first mortgage interest rate. It is significant. It's very affordable. and either they're in a no income zone, so they still have to be within the 128. So if the Home Ready Lookup tool comes up, it's a no income area, then they get their lower rate, but they still have to be within my 128, right? So my 128 limit's always gonna be there. Or if you happen to be doing a loan for a borrower where their income falls under, if it's not a no income, so you're just looking at the AMI amount of the income and your borrower falls under that, they can also get that lower rate. So just a couple more options to do even some cooler stuff. And I'm just gonna be straight out there with you guys. I was like, oh, big deal. So the limit is in LA County is 64,000. It's not gonna happen. I was just like, I was not on the bandwagon with this program at first. 40% of our deals, the first month that we launched this, were at the LE rate. So it's working. It's working. These people are getting a way better rate. So it's just another option. These programs, without the down payment and the closing cost assistance, your borrower actually does not have to be a first-time home buyer. So especially on the conventional, they could get the lower rate, lower MI, but no down payment or closing cost assistance. And they don't have, you could do this for your repeat buyer, for your person that maybe you're helping them sell their existing property and maybe they're moving up a little bit, or whatever the case may be, but they're going to sell their existing product and it's not enough to cover the 20%, right? So you will have MI, so at least they can have the Macy's Wednesday special MI, right? When it comes to those programs. So that actually does not have to be a first-time home buyer. What triggers the first-time home buyer rule for CalHFA is down payment, closing cost assistance. So ZIP, My Home, the school program, anything that's the down payment or the closing cost, that's what's going to trigger the first-time home buyer rule. Okay?
Do repeat buyers have to take the home buyers?
Nope, we waive it for them because they know what it's like to own, right? So we do waive the home buyer education for them. What else did I want to tell you on this? I know there was something that had to do with, first time home buyer. Oh, I'm sorry. We also waive across the board for the down payment assistance as well, the first time home buyer rule, if your borrower was affected by a FEMA natural disaster, which, you know, in California, half of the state was, well, both half of the state were on fire last year, right? So going back to Santa Rosa in 2017, so from that event forward, October of 2017, if your borrower was affected or lost a home by in a FEMA natural disaster area, we waive the first-time home buyer requirement. Okay, they can do down payment assistance, they can do closing cost assistance. All right, so just throwing that out there as well. All right, so now's the fun stuff. This is our two options for the frosting layer, if you will. This is the school teacher and employee assistance program. So this part can do either down payment or closing cost assistance. It can actually be either one. But of course, when you layer it with ZIP, it's going to, by default, because ZIP has to be closing cost, it's going to mostly go towards the down payment. And that's totally okay on these. Okay, totally okay on these. So the teacher program is available, and I shouldn't have just called it that. I actually just broke my own rule. It's not just a teacher program. Okay, it's for anyone who works in a K through 12 public school, a teacher, a teacher's aide, the secretary in the office, the custodial staff. It's the bus driver. It's the coach. It's literally anybody who works in that K through 12 public school can have access to the school teacher and employee assistance program. So this is going to be 4% of the sales price or the appraised value. Appraisal comes in low, we got to cut it to the lower appraised value. But this could also be a fix if your appraisal comes in low and your borrower only had their minimum down payment. You could actually look at going CalHFA for the fix. Their minimum down payment can go towards the gap, and then My Home or the school program can be their minimum down payment. So it actually can be a fix to when that happens sometimes. 3 1/4 simple interest. So this one does have an interest rate tied to it. It's still all deferred for the life of the loan. It's not a gift. It's not a grant. It does not forgive. Okay. So they will have to pay it back. It's 3 1/4 simple interest though. So it's not compounding interest like a regular mortgage compounds, right? So it goes, you add the interest in and then the interest is added to the principal and then it's recast at the interest rate again. That's not how it's working on these. So on that $10,000 example I gave you earlier, if they were doing a $10,000 school teacher program at 3 1/4 simple interest, their interest would be $325 a year. And the next year it wouldn't be 10,325 times the 3 1/4, it would be another just $325. So again, it's just a very affordable way to finance their down payment, and it's all deferred. All right. So they will have to pay it back, but it is all deferred. So not everybody works in a California public school, right? So we have the My Home Assistance Program. So My Home is 3.5% of the sales price or the appraised value, whichever is less, at the 3 1/4 simple interest. So all my examples are exactly the same. It's just that the loan amount, the amount we lend on this one is 0.5% less. So now we're at 3.5 instead of 4. It can be down payment or closing cost assistance, only first time home buyers. And yes, we can absolutely combine it with those ZIP programs. All right. So if you do Cal Plus with ZIP, you can do My Home or the school program, and then you can do the ZIP for some closing cost help. So I'm going to put this together, just a real quick example, especially on the conventional loan. There's leftover money here. So I don't want you to get hooked on the fact that that 2 or 3% isn't enough. I mean, it probably isn't enough, but there's still some money on the table here as well. So if you are doing a conventional where you can go all the way to 97 LTV, right, on the first mortgage, 3% of this will cover their minimum down payment, right? So you have a little half left over that can go towards the closing costs. Okay, so between that, maybe a little seller concession, maybe a ZIP 2 or 3%, then that's going to be able to take a huge chunk out of what their minimum into the transaction is. Okay. All right, so we do have to talk about the bad word in the room, the overlays, right? That's the bad word. So we are definitely coming from a position that we are trying to set these borrowers up to be successful homeowners, successful in this mortgage. So we do have some caps on some of the credit. Even though we're not credit underwriting, we do cap the lender. So especially when I talk about this, please keep in mind that Simple Mortgage and Stearns, they both have other programs outside the scope of what CalHFA can do. So I don't want you to think, oh, Molly's minimum credit score is 640. I have a borrower that doesn't have the 640. There's nothing we can do. No, they probably have a program that will work. Okay, so just throwing that out there. But this is our overlay. For CalHFA, I have a 640 minimum score. I have a 45 back-end debt ratio. That's probably harder than the 640. That is a little bit more strict. They couldn't get you, so they called you. Yeah. We are looking for that automated underwriting. So DU approved eligible. DU is Fannie's desktop underwriter. So we are looking for that automated approval. We are looking for the Stearns approval. So Stearns can't submit that loan to us until it is fully approved with them, because we need to see that, because we rely on them to issue that approval. And we are also looking for home buyer education. Your borrower or your client does need to complete the home buyer education. When it comes to the CalHFA program, there's a link on the website if you want to get them started. Otherwise, your origination team, they'll get them started on that by utilizing the CalHFA link if they want to do it online. Or if you know of a HUD in person or a NeighborWorks in person class, sometimes those are less expensive than my $99 online class. That is totally okay too. But if it's not our online class, then it does have to be the either HUD approved 8-hour class or the NeighborWorks America affiliate. Okay. And that's all on the website as well. Only one occupant borrower has to do it. Sorry, I feel like I'm running out of time. I'm like, only one borrower has to do it, and it's good for a whole year. So here's my 2 cents on this. This is one of the few things that is an overlay for CalHFA that we are going to require. It will not hurt to get the borrower moving on their home buyer education sooner rather than later. It's going to help you. It's going to help the simple mortgage group. It's going to help Stearns, because part of this education goes through vocabulary, because we talk in a different language, right? We have lots of weird acronyms and lots of different ways that we talk around the CalHFA around mortgage in general. So it's going to help the borrower understand kind of what the lingo is about the buying process, about the lending process, all of it, what to expect. It's going to tell your borrower, to reiterate to your borrower, to your client, to not go buy a car during their transaction, right? So that's happened to a lot of us. We giggle because it's true. So it just is going to be helpful, not hurtful, I promise. And it's good for a whole year. So if your lender has them do it, they're out shopping with you, even if it takes, 2 months, 3 months to find that property, to get that offer accepted, you still have time in the bank. It's still good for a whole year. So get that going sooner rather than later. On the eligibility side, so this is the weird part that is not a Stearns thing or a simple mortgage thing. It's very much a CalHFA thing. The first time home buyer rule, but first time home buyer just might surprise you because it's not forever. It's just in the last 3 years. So as long as your borrower hasn't owned their principal residence in the last 3 years, we can still consider them a first-time home buyer. Even if your borrower owned a mobile home, like say in a park or something, as long as it wasn't on a permanent foundation or that they didn't own the land, either or of those, we still consider that. Even if a mortgage shows up on the credit report, we can still consider them a first-time home buyer with a little bit additional documentation. So we're pretty flexible on that. But it does have to be 3 years, and no interest in their primary residence. I can only do these loans on a 1-unit property though. So it doesn't work for a duplex, triplex, fourplex. I know some of your brains I know you were going, right? You're like, ooh, I can get some investment property out of that. That does not work on the CalHFA program. And then there's my punchline. I know I let it out early, but the income limit for Los Angeles County is $128,300. And if you also serve Orange County, just so that you know, this is very county specific. Orange County is 174 and some change. So it is based on instead of like Fannie Home Ready, I think is 100% of the AMI. This is 150% of the AMI. So it is a significant amount more because it's a true California low to moderate income home buyer, right? Sales price limit for the state is $765. Loan limits, I don't think will quite get you there, but just so that you know, I like throwing that out there because we do see $500, $550, $600,000 sales price, okay? And the limit is $765. All right. All right, so the process is actually super easy. Simple Mortgage is going to do their part here, get it over to Stearns. Stearns has this dialed in their offices, so they'll get the final approval issued when it's time, and then they will get the file over to CalHFA. Turn times for us, less than 24 hours. At least that has consistently been the case, but you can always check online. Our website shows you exactly how many days CalHFA is taking for our review process. And then even though I know it's a little painful that process happens before docs, but as soon as we issue our conditional commitment to the lender, okay, we bless this loan, right? It's all good. Then that gives Stearns the green light to draw docs, fund, close. They don't have to wait unless something major changes with the loan. They don't have to wait on us. They pre-fund this, so it's their money. You don't have to wait for funds from us. None of that. There's nothing that's going to hold up your funding when it comes to the CalHFA side of the product. Okay? Questions, concerns? Did I even get? I know I talked fast. I'm sorry. I know there's lots of information. Now I feel bad. Did any of you? Nobody asked a question. I just talked straight. I did breathe. I might have talked the whole time and not breathe. Can I please that? answer a question
Yeah, I
for
have a
you.
couple questions.
Cool. Now that you've shut up, I can ask a couple
All
questions.
right, so number one, the lender funds, down payment assistance, you put that as a second lien,
Mhm.
right?
Mhm.
And then if you do the ZIP program, then you put that as a third lien.
Mhm.
So you have 3 liens on the property.
Yep.
Okay.
All very affordable 3 liens, 0 interest rate, 3 1/4 simple interest.
Number two, who pays the LO? That's borrower paid?
Borrower paid, but with some help, right? So when I say it's a borrower paid transaction, that's just as opposed to a lender paid transaction. So all of our rates are at par, right? And for you youngins in the room, par means 0. Is that, okay, she must, it's sorry, it's a lender joke. I didn't go over with it. So all of the rates are our rates and they're at par, but there's a savings built in because we don't have the loan level price adjustments. We don't have hits for condos. We don't have hits for FICOs, none of that. So every time your lender has to take a hit for that, it makes my rate a little bit better.
But they're still gonna have to come out of pocket for something, right? So
Ish.
if we're doing 500,000 and a point and a half.
Well, 500, once you go over conforming, yes, I will say almost, no, the answer, not even almost, every time they will come out of pocket. Because I can only finance 95% on the first mortgage and my home, which is the most common, is only 3.5. But can we just put this into perspective for a minute? A $550,000 sales price house and their minimum down payment is 1.5. Okay, that's still a rockin' deal, but to answer your question, yes, they will have to come out.
Third question.
Sure.
I've seen instances where now there's a lot of defaults, especially this year, where CalHFA is foreclosing on people.
Nope, not
As a
us,
foreclosing loan.
not us. We don't, so, we don't have the first. So, and we will even we used to up till now, so June 30th is the last to be able to, even though we say it has to be paid off at a refinance, we've had a exception, if you will, in place that if the lender shows that it's a better loan, that we'll even let them refinance and put the second and third back. So we're not foreclosing on the second and third, I promise.
Someone on the webinar is asking about Ventura County.
Sure.
Yeah, so just basically, does it apply to Ventura County?
Yeah, absolutely applies for Ventura County.
Riverside?
Yep,
Riverside?
applies for
Any
all,
county.
yeah, it's anywhere in the state of California. What I was gonna try to do is remember the income limit for Ventura, and I just don't have it. Riverside is 128. Oh, did I lose my clicker ability?
We'll look those up.
Well, I
Because also
know, I
loan
can,
amounts are not the same in Riverside County. So your high loan limit in LA won't apply
That's all right.
necessarily in Riverside County.
so if LA was 128.3, right? Is that what it says?
Yeah.
Anybody remember?
Yeah.
So then Riverside's 128.7. I always get the two. It's a little bit different. So, but it's right there. But Ventura's higher. All right, just so you know, because
Ventura is 176,850.
awesome.
Yeah.
Yeah. So Ventura definitely, yeah, it works anywhere in the state. Thanks, Jonathan.
Yeah, no problem.
So a little bit of tidbits. I'm sorry, we are just pushing right. And here I had all this, glorious. I thought I was going to get you guys out of here early today, and I'm right at 1 o'clock. So sorry, lots of good information though. I hope you enjoyed the class today. The website has videos on all of these programs. There's a loan scenario calculator. Here's the thing. If you don't even have to believe me. That loan scenario calculator will let you plug numbers in. And if you have an adult child, you're trying to get out your house, it's a great way to take a look at the CalHFA program. The children that you don't have to come up with their, help them with their down payment, you don't have to co-sign for them. Just go on that loan scenario calculator, start plugging in numbers. You will see how that will work for you. I mentioned we also put our turn times on the website. Sign up for our e-news so you get lots of good information. My contact, I need just one more slide. I was so close, sorry. All of my contact information is here as well. You have my direct line at the office. You have my email address. You even have my cell phone number. Can I just tell you, a state employee just gave you their cell phone number. Can I have a little credit for that? Thank you all so very much for your time today. I appreciate you so much. Thanks, guys, for having me out. Thank you.
so much for that.
Yeah, my pleasure.
I know it's a lot of information, and we are doing these, we are certified to do these in-house. So basically what that means for you is you come to us, we give you all the information, we pitch your loan, we sell your loan to your client, and then we underwrite it, and we have the capacity to underwrite it in 30 days, okay? What that means for the realtor though is that you're gonna have to stay on top of your escrow packet, because like you heard, this needs to go all the way to clear to almost like right prior to docs before it's gonna go to them for that 2-day approval, okay? Which means that everything that our underwriter requires of the approval needs to be clean before we can move forward with down payment assistance. The biggest glitch right now is if you don't turn in that escrow packet on time, we don't have vesting and we don't have insurance. Without insurance, we can't clear to close your file because we can't even issue out your CD. And without your vesting, we don't know who's actually gonna go on our title, okay? So those on your end as real estate agents, that the minute you get it, needs to be done within 24, 48 hours max, okay? The other thing that we're gonna do, because this program is gonna become, we're expecting it to become very popular, especially when it starts becoming a buyer's market. As you can tell, it can't just be a name and a number. We're gonna need a little bit more from you as an agent to help us as lenders basically funnel these loans faster, okay? There's gonna be a basic needs list. Hey, you know what? This is what we're gonna need from the borrower so that the borrower knows that this is coming, okay? Otherwise, it'll take us days by the time we connect with them, by the time we get paperwork, it just takes too long, okay? That's number one, the list of necessary documents. The other thing you're gonna get is the process. How do you go about actually getting somebody pre-qualified and actually getting these loan scenarios that you see here, okay? They're very easy to create on your own, but we will do those for you if you need them once we have a full package for the client. And the other thing you're gonna get are really cool down payment assistance flyers. Actually, the website is really user-friendly, and it has a space, a place where you can go and create your own DPA flyers for your own marketing. So we will teach you where to go, and we will send you the sample flyer. They're customizable, so you can actually put your name and your agency and all that other good stuff. Teacher program. Did you touch up on that? Okay. It's not just for teachers, right? So let's get off of calling it that. So we'll also customize a flyer for you to be able to take to different schools or your child's school and actually market to teachers and administrators and the guy who's cleaning the school.
Yeah.
Right?
Everybody.
Because all we need is a pay stub from LAUSD or the school district, and it'll work. Okay. So please make sure you do not leave today without actually filling out that information. Be clear with your email, and give us a couple days. We will have that email in your inbox individually. Questions?
This isn't the police or the medical field people, is it? It's just-
No.
There's a different one.
It's this
Police
first,
one.
yes.
Okay.
But
They can use my home, sorry.
They
My
can't-
Yeah.
home will be able to, we will be able to use it. Any other questions?
What about VA?
We can do VA with this program. Okay? So you could do VA 100% and then get closing cost credit.
So as a buyer, as a realtor, our buyer is predominantly 550,000, 4,500, and no maxed in income of 128.
Yes. So 128, let's talk about that income limit, because when you are actually talking to a buyer, let's say you're talking to a teacher. If it's a decent salary teacher, you're clearing about 75 a year, okay? If that person's married to somebody who earns another 60,000, you just went over the threshold, okay? So then at that point, we have to decide, okay, are we gonna use only the teacher? Are we gonna use only this other person, right? Because remember, combined, the income we present to CalHFA cannot exceed 128, 300.
And just to throw it out there, because it's a common misconception, if grandma lives in the house, we don't do a household income. It's only the people that are going on the loan. So we won't, if grandma's not going on the loan, then we don't have to use grandma's. And if we leave one of the partners off, and you qualify with just the $75,000 teacher, I'm not gonna entertain the other income either. So it's not a household income.
The earlier example that you used of the realtor giving up half a percent, it could be used the same example at 3%, giving up 0.5% and keeping 2.5%, am I correct?
Yes. What we're
So that's not capped.
No. If you want to give 1%, you want to give half your commission. On your end, there is no stipulation that says that you cannot contribute to closing costs. It has to be for closing costs though. We cannot use it to supplement down payment, right? So at this point, this program would have to do your down. And then if there's money, let's say, I think you gave them the scenarios that we got, right?
Which
Your
one?
presentation, where like the person has to come in with like $3,000.
Oh, I didn't do a full-blown
Okay.
scenario.
There's scenarios that you'll see where like the person has to come in with like, let's say $3,000 at the end of it all, right? If you wanted to say, okay, I'm gonna kick back half of my commission to that, which is, let's say on 500,000, that's what, $2,500, then your buyer would have to come in with that additional $500. Does that make sense?
Yeah.
And you're not capped. Let's say you wanted to do the full $3,000, you could. We can't do that as lenders, but you can do that as agents.
But closing costs can be increased with the buy down of the MI, is that correct?
Yes.
So if you're at a place where you're using all of there's money left over, you can do the buy down on the
You
MI
can-
to spend the rest of
Yep.
it.
Just have
At
to
that
benefit
point-
the borrower.
So
Yep.
you can use your commission to buy that down.
Sure.
Yes.
Okay.
Not all of it. Let's
Right.
be very serious.
From a realtor standpoint of view, if I can pitch all day long, I'm gonna give you 0.5% back.
Yeah.
There's people
All
standing
day.
outside.
Yeah.
If that to me is like the story that you pitched
Mm-hmm.
right now earlier. Heck yeah, I would do that all day long if I'm gonna get 3%, which I'm gonna go back to the buyer's agent. I'll get you full price and even higher if you give me 3%. And then I give that other 0.5% to the buyer through that, buying it down, the PMI and getting that money, then the buyer's coming in with no down. You don't need referral business you're gonna get,
Mm-hmm.
just from that alone.
This is a great tool for you to use and put out there as a marketing resource for you, right? Is everybody gonna be okay with down payment assistance? Probably not. Why? Because it doesn't necessarily follow market rate, right? So like if you looked at those rates, they're slightly higher than what market can do today. But you're also coming in with no skin in the game or very little skin in the game for these huge loan amounts that you're trying to like give
Right.
you. The other thing about the down payment assistance program that I think is really cool, because I've done CalHFA down payment assistance years ago, they no longer care about household income. They no longer care about really how we structure the loan so long as it meets their basic 5 guidelines, right? So for us, it puts us in a situation where we're basically doing your loan like we would do any other loan. You know, it's not like before where we had to underwrite you and then we still maybe would be denied. So imagine going all the way 17-day contingency period and then, oh, you don't have a loan because you don't have down payment assistance, right? And the biggest factor that I see compared to, for example, LA City is that you don't have shared appreciation. And I've seen those a lot lately. I'm actually doing shared appreciation. What that means is there's some down payment assistance programs where not only are they going to let you borrow the money, they are also your business partner in the transaction, which means that if they let you borrow 5% of your down payment, then when you refinance to pay them back, you owe them 5% of your equity bill. Okay? Shared appreciation. So if you bought a home for $200,000 and at the time of refi we're appraising at $500,000, you owe them 5% of that gap. Okay? For some people, it's a lot higher on that percentage. I just looked at a client that's in San Bernardino with 50% shared appreciation.
Wow, jeez.
Okay? So he ended up borrowing $15,000 to have to pay back about $80,000. Okay? So you have to be mindful of the fact that this program is very generous in what it's offering the client. But it is a program where technically I haven't seen one scenario where if you are going to use a a lender like us, the client will come in with no money down. I'm still waiting on my friend from Wells Fargo that does these loans to actually send me something where they've seen zero money. Because I have yet to see one where the client actually comes in with nothing. Because we're in such high cost area, right? So when I see it, I'll send it out, but I haven't. But again, this is just for you to have.
But we have, for the record, we have.
You
seen
have?
that.
Okay,
Oh, yeah.
good.
Oh, yeah,
'Cause
yeah,
I
yeah. It
haven't,
does
not
happen.
here.
It doesn't happen all the time, but it does happen.
But,
And just 2 cents on the interest rate thing too, keep in mind that she's talking about when you're using all of the assistance. So like our regular rates with just My Home or the school program should be about market. So like and sometimes even below, like our FHA 30-year fixed today is only 3.875. And we've been under 4 for a little bit now. I mean, it varies day to day, but it's been really, really good. And then in those LE areas, it can also, on the conventional stuff, it can also get a lower rate. So just throwing that out there. And then every time, you know, if it's a condo, my rate's still 3.875. If it's a lower FICO, my rate's still like every time you have to take a hit for a rate, we don't. So every time in some of those special circumstances, my rate can actually get to below market. So just keep an eye on it. It's just another option.
So I also wanted to add something, and I feel like a lot of the agents are a little hesitant to use this program because it's not as appealing to the sellers. But what we do at Simple Mortgages or any other pre-approvals that you might see, nobody really discloses where the down payment comes from. So basically you'll get a conventional approval, your buyer will, and then we'll just add the down payment portion that they're giving, but we're not disclosing where that down payment is coming from. So your offer will not make anybody nervous. Like nobody has to know where that down payment is basically coming from.
Any other questions before I let you go?
We have one more from one of our webinar attendees, and either of you ladies could answer this, but they're asking how much should a lender charge, more or less?
So I've seen, and this is just based on what I see in retail, I see them charging 2 to 2.5% to do down payment assistance programs. That's really high. Here at Simple Mortgage, depending on your loan amount, you're probably going to see something in the vicinity of 1 to 1.5%.
And just so that you know, we put our own little layer of protection on it. All of the lender fees between the broker and the lender, all of that added up, underwriting, processing, origination, all of it cannot exceed 3%. We test that on every single loan, and we will not let them go over that.
So
they eat the cost if it exceeds it then?
Yeah, they would have to reimburse it back to whoever paid it. I mean, the actual review, and the lenders know, but the actual review doesn't happen until the final CD post closing. So it's not gonna mess up your deal post closing, and then we would come back to before we bought the loan, we would say you have to reimburse this. Yeah.
So that's for you to know, full transparency, what we are doing here at Simple Mortgage. The cool part about it is that we are technically functional as the retail lender would, because we are correspondent lending with Stearns. So whatever it is that's on your approval is what they're gonna want from us. They're not gonna add an additional layer to it once it goes to CalHFA. Okay. Any other questions about the products or the program? Did everybody sign up?
You guys are so patient. You guys are so awesome. You even stayed. Oh, my heart. That's awesome.
We're actually very excited to be in this program. Thank you so much for coming today. We know your time is really valuable. We hope that this helps a lot of your clients. And again, please be mindful that there are 4 of us representatives of Simple Mortgage that are actually certified to do these programs. So you get to be a preferred agent of ours. Please don't lose that status by, not keeping up your end of the deal, right? So if we're requesting something of you, it's because we need it to make the program work. We are not just making it seem like we want more work for you, okay? So please be our teammate in this so we can get as many people streamlined as possible. Thank you so much for coming.
Thank you.